we have the pleasure to have Mr. Luca Colussa, CFA, who is the head of factor and quant equity at Generali Asset Management. Luca, thank you very much for being with us and welcome. Luca is going to take us through in these hour and 15 minutes without being too technical, otherwise we're going to lose some of the students and maybe even myself, the formulas, but really giving us the hands-on on what factor is, what thematic is, how they work, and especially in these last few years, how the market has been behaving with this factor. So again, thank you very much. We have people connected online via Zoom, and we have people in the room. Luca, the floor is yours. Thank you.
Thank you very much, Professor. So as Professor Zanardo just said, I'm here presenting, let's say, this factor and thematic investing. As you read from the slide, I'm the head of factor and quant equity. So most of our presentation will be actually on the factor part. But anyway, we'll touch briefly also what is thematic investing. And here is basically the distinction between factor and thematic investing. So what is factor investing? Factor investing is basically investment guided by a factor. A factor is basically every variable that can be linked to excess return of an asset or investments over time. And this linkage between the variable and excess return is usually based on a theoretical framework, and we'll see a few of them in a moment, or statistical evidence. And we will see this more in an example later in the presentation. Factors are, as I said, are based on economic theory or empirical evidence, but what is important here is that the evidence is based on past data, observation of past data. So we are not projecting anything in the future. We use the relationship that we can extract from past data or theory, economic theory, which is anyway usually validated by empirical data to understand which is the relationship. Quantitative methods are often used, not necessarily required for that, but usually this is quite the core of the activity, and because indeed statistical evidence strengthens the case for this kind of investment approach. Example of factors are value, size, momentum, quality, but we will see many more later in the presentation. Let's have a very quick look to thematic. As said, that this is basically the only slide where I touch thematic in this presentation. So thematic investment, especially to understand the difference between a factor investing, is something that is based on a theme, something that can be linked to potential opportunities on the economic background, in social technologies, changes, etc. The big difference compared to factor investing is that here we need to anticipate future trends. So we make basically an exercise to predict the future. So past data can be helpful, let's say, or at least episode in the past that resulted in structural changes can provide some guidance in the way we can think about to detect the themes for this thematic investing, but it's really an exercise to think about the future. Compared to the factor investing, qualitative assessment is plays a much bigger role. Example here: aging population, artificial intelligence, cybersecurity, robotics, ESG has been a quite important also thematic investment in recent years. But let's focus now on the factor investing part, starting from an introduction again, I don't want to bother you too much on formulas, but let's just try to understand the logic behind this. The first attempts to try to explain the way the market and the assets in the market behave was the capital asset pricing model. So it was developed by several economists in the 60s, so it's more than 60 years ago now. And basically the idea was to link the return of the asset, it's the left side of the equation, so E expected return R, it's our asset, which is linked to the return of a risk-free rate. Let's imagine short-term bills issued by Germany or the United States, whatever, plus a premium, basically, which is linked to the one of the correlation with the market. So we have the return of the market versus the risk-free rate. So it's this is the market premium multiplied by a beta. The beta is basically the sensitivity of the assets to a market. An asset can show a larger, let's say, volatility, and beta is larger than 1, and we may say these assets is somewhat pro-cyclical, or it tends to move at faster ways compared to the market. On the opposite, we can have assets that have a beta below 1 and could be considered defensive assets. Here's a representation, let's say, of a formula. The one I showed you before is basically the formula on the right chart. So linking the beta on the x-axis with the expected return. So you see, it starts from the risk-free rate. We have a market at 1, and all the assets would stand on this security market line depending on their beta. The graph on the left is actually almost the same. The only difference is that instead of beta, we have expected risk in the x-axis. So it's a measure of volatility, but indeed, as we saw from the formula before, beta and volatility correlation are course interlinked. Okay, that's the theory. The problem is that does this fit the data, and especially does the data in the future continue to provide evidence that this relationship holds? Not so clear, because let's say here you see two charts I prepared for this opportunity, and if the cap model holds, you would see the asset basically staying on that line or below. Below because some of them can have idiosyncratic risk that according to the cap model is not rewarded, because only systemic risk, so the relationship with market is rewarded. Especially on the chart on the right, you see a number of dots that stands above the line and have a beta below 1. That's called the low volatility anomaly. So low beta stocks that offer higher return compared to the one predicted by the model. So this is one of the first observation that put, let's say, the cap model into question, saying basically that it's not sufficient to use only the market as a factor to explain the market and the sensitivity to the market as the only elements to explain the expected return of an assets. So what happened? New models, more complicated ones. The first very famous one is the Fama-French three-factor model. They added 2 additional factors next to the market. So the first half of the equation here is the very same as before, but you see then you have a beta size multiplied by the size premium, and basically this basically answers to the fact that assets which had a smaller size tend to perform better compared to the cap predictions. And the other one was the high minus low premium factor. It's basically the value premium. So assets that are also book value is quite low compared to their current market price tend to perform better. This is quite an important relationship also in current analysis. Usually may see that investors talk about stocks being cheap or expensive based on their market multiples, the price earnings, etc., etc. This is basically the economic theory behind this assumption. This is something that holds, but probably not much in the short term, but more into the medium to longer term, with longer term being periods over 5 to 10 years. Additional factors, additional models. I think one important factor that is worth mentioning is momentum. That is basically the tendency of stocks that have underperformed in the past to continue to outperform also in the subsequent periods and vice versa. So the losers continue to be losers and the winners continue to be winners, let's say. This is very important, and this is the basis for trend following strategies, so, which basically are based on this assumption, and that basically you continue to invest in stocks that have performed better and underweight, or do not invest in ones that have underperformed over the recent past. Fab & French also made a new model in more recent times. They added additional factors, but anyway, you can continue to add factors. The point that sometimes is getting complicated to understand which is the incremental impact of each factor. So to clarify a bit what is the current most common approach at this moment. Factors can be divided basically into very big categories. This is a taxonomy by BlackRock. You know, BlackRock is a very big passive asset manager. They tend to distinguish them in macroeconomic and style factors. Style factors are the one that basically I mentioned so far: value, momentum, minimum volatility, quality, profitability, size, etc., etc. Macroeconomic factors are, on the other hand, the ones that are linked to some variables that impact the economic cycle, interest rates, inflation, the credit cycle, so defaults, or could be liquidity, emerging markets, inflation. We'll see later an example on inflation built around this taxonomy. Some additional information that could be helpful in terms of taxonomy is the distinction between explicit factors and implicit factors. Explicit factors are the one we discussed until a moment ago. So they are linked to economic or financial intuition. So it's very interpretation of those factors is very clear, and described here a bit how this works. The alternative is to try to extract factors from data. So it's really the quantitative approach, let's say, to factor investing. And one of the most used techniques here is principal component analysis. PCAs are very helpful because starting from the data, basically the returns or the assets, they are able to build factors that explain decreasing shares of the volatility of these assets, and have also this very useful characteristic, which is orthogonality, meaning that the factors are linearly uncorrelated from one to the other. So it's quite a useful way to build them. The big problem here is that interpretability of these factors is way less obvious. You can reconstruct or try to understand what the factor is driven with the subsequent analysis, but you don't know a priori which is the explanation for that factor. First of all, it would be good to have a look at to MCI indexes, which is a very big category, very big market provider in terms of indexes that are very often used also for benchmarks against which, example, my funds or anybody funds are usually measured. MCI builds several equity indexes based on equity factors. The first ones were the one we discussed before, so growth, value, momentum, quality. At a later stage, as we said, we found the minimum volatility. So again, linked to the low volatility anomaly we discussed before. We added small caps, so besides one, high dividend yield, it's basically the stocks that tend to pay a lot of dividends given their price, etc., etc. What MCI did at some point was also to build a multi-factor model. So diversified multi-factor is an index that combines these previous mentioned factors all together with a given weight scheme in order to respect some criteria we made, and basically to try to simplify the measurement of factor investment compared to the standard benchmarks. And we can see a bit of this into the next in the next slide. What I did here is looking at factors indexes in the US, was basically trying to understand which is the correlation of these factors with the market overall and from basically within the factors. The first column, the one that Professor is now basically showing with the mouse, show the correlation of the factors with the market. Usually you can see that these correlations are decently close to zero. Sometimes minimum volatility is a bit by construction quite negative because it's focused on defensive names, the ones that show a beta smaller than the market. So basically the ones that tend to fall less when the market declines. So it is quite expected that it is a big number, but on average, the other ones are quite close to zero. So basically, this means that these factors are uncorrelated to the market. So this is a useful feature because it can add to the diversification of a portfolio. When you add, let's say, a factor strategy overlay to a traditional portfolio, you can reduce volatility given the low correlation between the factors and the market itself. The rest of the table is basically, as I said, a correlation of excess returns of these factors each other. So you can see some factors are almost defined in opposite ways. So value growth for MCI are basically, it's basically a partition of the investment universe. So almost half of the stocks are in the growth camp, the other half is in the value camp. And you see the correlation is quite negative, almost close to minus one. But in general, there are, for example, other interesting observation. High dividend yield and minimum volatility stocks, you see the correlation is quite elevated, is about 0.7 and something penultimate line. Yeah, exactly. These stocks usually are one that show stable and a stable environment. They're not for sure disruptive stocks, so it's usually something working in example, could be insurance, could be telecommunication, could be utilities, but it tends to be defensive compared to the market and to pay quite elevated dividends. I don't know if you have any particular question on this, but on average, you see correlation between factors are also in this case not too elevated, apart from some exception, as I mentioned before. Interestingly, if we go and see the diversified multi-factor, the correlation of a multi-factor index compared to the other factors in the market, you see here correlation are quite low. So basically, combining more factors together seems to give quite a diversification benefit for portfolios construction. So this is a very important feature, because usually this means that multi-factors tend to have smaller drawdowns and could potentially have higher return potentials. Let's have a look of actually what happened in the past 25 years and plus 2 months for this year for the market. First column again, and then the excess return of each factor versus the market. You can see that I think the very first impression, factor excess returns are not stable at all. So all the economic theory that said we try to detect stable excess returns from factors, it's more complicated than that, because indeed many additional features can come into force and drive the performance of these factors, including the actual flows, inflows and outflows of investors into specific factors. If we look at the last column, dividend multi-factor, you can see that for the first 15 years or so, you only have 2 or 3 episodes of negative returns. So multi-factors, factor investing became very popular exactly because of this. So positive returns, limited drawdowns, potential benefits, diversification benefits. So this, of course, attracted a lot of interest from investors. You can see this change quite a bit in recent times. 2019, 2020 was quite a bloodbath for this kind of investments. Again, 2023 was quite a negative year. More in general, looking at the other factors, as said, there is quite a lot of volatility. Some factors show higher volatility. We may see momentum, so with swings, positive, negative, double-digit ones, so quite large. The same applies to value and growth. Also, small caps have quite important one, along with high dividend yields, which, as you can see, is correlated also with value quite a bit in recent past. The factors that seems to show less volatility, in particular, is the quality one. So usually, I think there is actually no double-digit movement. There was only a very negative year, which was 2003, which was basically the year after the very big correction of the dot-com bubble ended. So from March 2003, with the start of the Second War in Iraq and the operation by the US in Iraq, the market turned a very positive, let's say, a wave. You can see the return of the year was plus 29%, so very, very big one. And in that case, probably low quality stocks rebounded thanks to this impulse that was also a political one. But apart from that, you see returns in this factor are decently positive on average, especially the positive ones tend to be larger compared to the drawdowns, which is always a very nice feature to have in portfolios.
So if we make an example, let's say 2024. So the US equity, the broad US equity market returned 25.1%, and the value factor had a negative return absolute of 10.7, and so on, correct?
Sorry to correct. It's the excess return versus the market. So
Right.
actually the return was 14.4, basically.
Minus 10.7 doesn't mean that value stocks declined by 10.7%. That means that they return 10.7% less versus the market. So the market returned 25.1, so 15.1%, 14.5, something like that, correct?
Correct, yeah. We can have a better understanding on the long-term potential of this factor in generating excess return. Here I focus again on the foremost, let's say, famous factors: value, growth, quality, and momentum, and also the one for which we had data since the 75, so it's almost 50 years of history here. You can see that indeed quality is a factor that tends to have more or less the same volatility of the market, but a higher return. You see the dot is basically exactly above, almost so by almost 2% point higher, and we can definitely say it's very attractive to be invested in quality. It has been the case for most of the past 50 years. Momentum also is quite elevated in terms of excess return, but this comes also with higher volatility compared to the market. This is very consistent with what we said in the previous table. If we look at value and growth, basically both show more or less the same performance of the market, especially growth versus the market, but you see that volatility is much higher. For value, it basically we have a lower return, a lower volatility, a bit lower return, lower volatility. So it is definitely less clear to say that these factors are generating stable excess returns over the long run. This is more evident when we compare, we calculate the information ratio for each factor. The information ratio is basically the difference of returns between the factor and the market. So the vertical distance in the chart on the left. And we calculate then the relative volatility between quality and market returns to make the determinator of information ratio. Basically, here we obtain a number. Of course, the market is by definition zero because the excess return of the market versus itself is zero. But you can see that value and growth, we have a number that is basically around zero, meaning that there is little statistical evidence that these two factors are able to generate excess returns over the long run. This doesn't mean that they are not able to generate a return on a shorter period, but over the longer run, this is definitely less the case. When we look instead to momentum and quality, I think here is more interesting. Especially quality is a factor that is able to, as we saw here, combine almost the same volatility, but with a higher return. So the information ratio for quality is 0.32, which is not huge, but still it is a decent number. For momentum is 0.25, also because of the higher volatility that momentum generates. I tried also to recombine the four factors together. We said that combining all the factors could generate diversification benefits. And indeed, the combination of the four factors equally weighted shows an even higher information ratio of 0.38. So quite a decent number. I think we can go and see what happened to factors in over these periods. Here I plot the cumulative excess returns of each factors versus the market. And I think it's very interesting to note that both quality and momentum tend to add this upward trend. For quality is more regular, is a bit more volatile for momentum, while value and growth basically they're around zero, around 100, which means aligned with the market basically. But you can see cycles, quite big cycles. This is even more evident when looking on the chart on the right. You see that basically value dominated in late 70s until mid 80s. It's the period where inflation was very elevated. Then it suffered quite a lot from 85 to basically the burst of the dot-com bubble. When the dot-com bubble exploded, we had again this outperformance of values versus growth. And basically, after the great financial crisis, we had this also uninterrupted underperformance of value, with only some revival in 2021-22 periods when inflation spiked again after the stimulus following the COVID shock and the war between Russia and Ukraine. So what is important in factor investing is try to link, let's say, the developments of these factors with something that you can better control, because we cannot just say, okay, let's buy factors, the growth one, the value one. We need to have a rule to understand which is the right moment to increase exposure to one factor compared to the other. For example, looking at value versus growth, which is indeed quite the most important one, as we saw because of these very prolonged cycles. The chart on the left show basically that value tends to lag growth, so to underperform growth when market price multiples expands. This is basically the very definition of value. Value stocks usually have low price earnings. Growth stocks have high price earnings. And when we have an expansion of this price earning ratio, growth stocks tend to perform better. So you can clearly see there is a negative relationship between the two. What is more interesting to note is that these moves in the market multiples tends to be correlated to moves in interest rates. So when we have an increase in interest rates, multiples tend to contract. On the opposite, if yields move down, we have an expansion of multiples. And if we combine the two, we may say that in the end, growth stocks tend to perform better when yields decline, while on the opposite, value stocks tend to perform better when yields increases. And this is exactly what we saw in the charts below. So during the late 70s, when we had the first inflation shocks, etc., or after the dot-com bubble, or after in 2021-22, when yields move from in Europe from negative to 2.5–3%, and the US from 1% to more than 4%. Value stocks tend to perform better when yields move higher, and the opposite applies, of course. Growth stocks tend to perform better when yields declines. A final comment maybe on this section, and I think is anyway very interesting, because usually also when we present performances to clients, you don't show performances based on factors because it's less intuitive for clients. What you show is basically performance attribution, usually or by geographical areas or by sectors. GICS is basically the most commonly used definition of sectors in the equity space. So there are 4 levels for GICS. Level 1 is basically 11 sectors that are shown here in this chart. For each sector here, I computed this for the MCI World, actually. I computed the average correlation of this of the excess return of each sector compared to the market correlation with the value and grow versus grow factors and cyclical versus defensive, which is basically high beta versus low beta. And you can see the market stands basically neutral in terms of value versus grow composition. As I mentioned before, by MCI divides value and grow almost exactly enough. So half of the market is value, half of the market is grow. So this makes quite a lot of sense. But we see that the market has quite positive correlation with the cyclicals. Cyclical sectors dominates and have higher beta. So when they increases, the market tends to do better, and the opposite, of course, applies. Within cyclical sectors, the most prominent one is for sure information technology, which is a sector that has also a very strong tilt towards growth. So the right top right quadrant in this chart is basically the cyclical growth sectors. You see information technology, you have consumer discretionary. You can imagine that within consumer discretionary, we have the stocks like Amazon and Tesla, for example. Information technology, we have Apple, Microsoft, Nvidia, etc., just to mention a few. On the opposite side, remaining in the cyclical camp, if we want to have a sector that is very value, it's financials. Financial comprises especially banks. Banks are the ones that tend to benefit most when interest rates move higher, okay? Because their profitability improves, especially when the interest rate curve becomes steeper and the average level of yields increases. Industrial is also a sector that is somewhat value. Of course, we have to understand that all sectors are calculated versus the market. The market is very driven by the moves in information technology. So sometimes you move from one quadrant to the other just because of your correlation with information technology. Defensive growth, we have actually quite little sectors. Communication services is a very strange sector because it's a combination of a very cyclical one, which is media. For example, the Alphabet, Meta platforms, just to mention a couple of names, Netflix, and telecoms, which tend to be a very defensive sector. It was combined with a new definition in 2018, so you see is not much distant from the zero anyway. If we go for the really defensive sectors, usually the 4 sectors that are considered defensive are utilities, consumer staples, healthcare, and energy. Energy is more value, healthcare is a bit more growth, but these 4 sectors are the ones that are considered defensive. Material is a bit in the middle of nowhere, so it's cyclical, but not enough compared to information technology. Is for sure less defensive at the one I mentioned. Is decently value in the sense that when you have an increase in interest rates, it's usually because you have elevated inflation, and elevated inflation comes usually also with higher commodity prices like oil for energy or copper, industrial metals, gold for materials. So this is anyway quite an interesting representation because also on our side that works on factors, in the end, we need to express a view in terms of sectors and where to decide to overweight and underweight.
If you want just to pause here, should we take some questions, some considerations? A fascinating journey through time and markets characteristic and DNA. Any question is welcome.
Thank you for the very interesting presentation. Maybe just a quick question on my side. We see all these factors, and when we look at the market now, they are becoming even more and more important part of what people do, even in analyzing single stocks, the exposure that the stocks have to the single factors as also a way to bear in mind the kind of risk exposure and possible performance of these stocks. And do you see from your point of view, when you look at your funds, more and more interest from investors, even retail investors, to be exposed to ETFs or funds that are exposed to only one factor in their kind of portfolio allocation? Is it something that the people start to be more aware and they are looking to participate or to be exposed to some of these factors?
Yeah, I think yes, definitely yes. I would say that retail investors tend to follow a bit the flow, if I may, meaning that usually you tend to buy the stocks that everybody is buying, so the winners usually. So strategies like momentum are decently common, but I would say even more grow is one of the probably most common factors that also retail investors are considering for investments. There are indeed decent numbers of ETFs that tracks grow, sometimes also leveraged ones. And sometimes this also creates quite a turbulence. Why grow? Because if you remember from one of the charts before, in the past 15 years since the great financial crisis, grow dominated. Grow meaning information technology basically dominated for most of the last 15 years. Of course, when you follow this kind of strategies that are winning for a very prolonged period of time, what is dangerous is the turning point, the sudden turning point. So events like the COVID, but even later on the war in Ukraine, the inflation shock, etc., that resulted in quite rapid disruptive market moves tend to be quite problematic in general, especially if leveraged instruments are used. Sometimes, let's say, for example, I think quite interesting episode that happened in recent past was the Reddit mania. So when there was a pool of retail investors or influencers that were pushing a given number of stocks that on which hedge funds had very strong shorting bet. So they're basically ranked with the stocks based on very short interest, which means to what extent it's usually hedge funds are shorting the stocks, betting on the future declines of the stocks, and they started to buy these stocks en masse. And we saw in some cases spikes of basically bankrupted companies moving from a penny to $10, so 100% moves like that, that resulted in very disturbing losses for some hedge funds. That's a kind of example of a factor investing. The factor that used in that case was short interest, which could be indeed an interesting factor to use. Of course, it's not a factor that is accessible to everybody because it's costly. Usually, it's private data compiled. But if you get, as it happened in that case, a decent wave of investor that went all in on that side, you can really move a market. More in general, looking at the institutional investors, I think again it's a matter of performances in the end. Usually, institutional investors tend to adopt something with some delay after it started to perform well. As we saw, factor investing became very common from mid 2000 years after it started to perform very well, and it continued to do so for quite a period. But if you ask me at this moment, is traditional factor investing so common at this moment? I wouldn't say so. It's more you really need to adapt your factor investing strategies to the prevailing condition, or at least try to find a combination of factors that tend to be less exposed to drawdowns, to losses in general.
Well, my question is about, for example, if you compare factor investing with, I don't know, another strategy, for example, investing in countries around the world, US, Europe, emerging markets, and so on. Is it more dangerous factor investing, since I think you have to make more decisions, think about the future, maybe you fall in behavioral bias, and so on. So is it more difficult to maintain this strategy compared to
other ones?
A world strategy, for example?
Let's take as the example at the world level, because otherwise it makes little sense. So let's compare strategies based on country location on global scales versus strategies based on factors still at global scale. In the last 15 years, basically, the only market you wanted to hold in your portfolio was the US. It performed massively almost every time. When Europe outperformed, it was only for very limited period for let's say 10% or so, but then he went for underperformance rapidly by 10-15% per year each year for the last 15 years compared to the US. It's a matter of correlations. In the end, when you buy the US in this moment, you know that you are buying predominantly information technology or stocks that are in a way linked and correlated with that sector. This means that you are buying growth factor, for example. So US is a typical example of growth factor. So it's hard to imagine to be positive US without being a positive value growth factor. So to me, it's not a matter of what is more dangerous. It's a matter to understand what you are buying. For example, within Europe, if I buy Italy and Spain versus other countries, I'm usually buying value factors because those indexes are more tilted into banks and financials and utilities. Okay, so I'm more exposed to that kind of factor, or that kind of risk, basically. So if I'm positive on rates, that I expect rates to go up, usually I should buy value. I should find the markets where banks or stuff like that is more present. So I would buy Italy or Spain within Europe, or Europe versus the US, for example, and stuff like that. So it's more a matter to have a good understanding of what you're buying, because similarities across sectors are way superior compared to similarities across geographies. So usually I tend to be I don't know, to buy financials everywhere, okay, because interest rates are going up everywhere. So let's say, so it's in that case, it's not a matter I buy more US or more Europe. It's a matter I need to have exposure to financials. Then I'll try to understand which is the best way to do so. But it's not a matter of what is more dangerous. Is as I said rapidly before, is a matter of interpretability and explainability to clients. So when I present a performance report to a client, it's definitely easier for the client to understand, okay, you have done better because you were overexposed to the US, which overperformed. This is very clear. If I say you perform better because you were more exposed to the growth factor, I don't know. I don't think the client is understanding in the same in the correct way. He may have some clues of what this means. If I say to him that I'm doing better because I am overexposed on the US or information technology, is a way better, let's say, way to communicate. Also, because factors they don't have a 1 or -1 correlation with sectors or areas, are something in the middle, sometimes quite close to 0. So it's not easy for the client, for the final client, to understand this, especially if it's not a sophisticated one. Well, for sophisticated one, understand this very, very clearly, of course. But it's easier to, again, express region and sector exposures rather than factors.
Another question?
Sorry, I have a question.
Yeah.
Yes.
Yeah.
It's a more general question. I'd like to know if you implement any AI tools in your day-to-day activities, be it the usage of chatbots like, I don't know, ChatGPT or DeepSeek, or any machine learning techniques for analysis.
Yeah, this is quite a big topic that has been explored for increasingly so, I would say, for the past 2 years, I would say. We'll see in a moment an application, let's say, of factor investing that we produced in-house. And on that experiment, that model will be developed, we have started basically throughout 2024, and we are continuing now, basically to extract the signal via AI machine learning techniques that, well, of course, have a big benefit to investigate a number of relationships that are on top of most non-linear ones, because most of the traditional approaches are linear ones, okay? But the reality is always more complex than that. So using machine learning techniques is is helpful, let's say, to detect relationships that are not easily detectable. Okay, then I'm still in the camp that you should better understand what the relationship is anyway. So I think the best way to use AI is to combine that with a solid theoretic framework, okay? Because getting you have problems with sampling of data. If you use too little data or samples where only one factors domains, for example, if you use only the last 15 years, I may be biased to have more growth stocks than what I should have over other periods, etc. So economic theory is very important. I think machine learning helps you to identify some relationship that you then investigate on your own and separate to try to understand which is basically the best environment where you may see that conditions to happen. So I see them, the AI and artificial and machine learning more as a tool to improve your analysis rather than to replace, of course, the creation of factor investing. Because if the data are the very same for everybody, the risk is to create two overcrowded trades. So everybody buying the same stuff and being underweight on the same stuff. And usually when you have turnarounds in the markets, turning points in the markets, this leads to massive negative adjustments in very short period of times, and you don't want to be there. And of course, it depends also on the strategy and the entity you are. Of course, an hedge fund may be more interesting to maximize profits even with high volatility. Other investor may be more willing to contain drawdowns. So it depends a bit, of course, on the environment that you are in.
I have a question on quality, if I may. So I'm looking at the slide here. It's interesting, as you pointed out, that quality provides with the same volatility of the market, but he offers superior returns on the left-hand side. And then if I look on the right-hand side, the information ratios. And the question here is this. There is a blurred line in quality. I make an example. Maybe you have stocks which used to be totally growth when they were smaller, Microsoft, Apple, that passed that stage, and then they became big, stable, cash flow generating companies. So the question is, are there any empirical posts or factors that whereas a company become totally quality or can be 100% identified with quality? I don't know if I'm being clear, but moving from one company to quality might take time. So what are the key signs of quality company? Are they all big cap? Are they all dividend generating? Are they all giving superior cash flow returns?
Yeah, usually the variables that you use to build the quality factors are one linked to return on equity, return on assets, margins, and stuff like that. So free cash flow generation is very important one. Yeah, I would say so. So indeed, that's true that there are companies that start are growing very rapidly, but they have negative cash flows. You mentioned a few of them, but Amazon was a loss-making machine in the early 2000s. Tesla has been a loss-making machine for most of the past decade, etc., etc. So of course you miss those stocks at first, and this could be quite painful indeed. But indeed, the stability of the metrics, the it's a better metrics that I've mentioned before compared to the other peers, and the stability of those metrics are key characteristics of a quality factor. So you want to have those metrics, margins, return on equity on assets, cash flow that are better than others, and stable, decently stable at least. Okay. So it's difficult to identify a very moment where this happens, but I think there is quite a tendency for these stocks indeed to, in the end, become some big companies, and this is quite persistent. So when you get a dominant position in the market, both metrics are likely to be very, very positive, decently stable, and it's unlikely that this leads to in and out from the quality factor, let's say. Then usually factors are built in a way, let's rank the stocks based on the variables I mentioned before. I sum all the ranks, and then eventually out of 100, I consider to be in that factor the top 25%, 20%, or stuff like that. It's usually the way factors are built. And on the opposite, I short the underweight in the stocks where I have better metrics and better ranks compared to the other.
And given where we are today in terms of markets, concentration, valuations, geopolitics, without giving investment recommendation, but just your stance, what do you think could, in terms of factors, what do you think could outperform over the next year or 2 years, given where we are today?
I always I reply this way. I usually always tend to be tilted towards momentum and quality in the portfolio. On quality, because even if it underperforms, it doesn't usually leads to big drawdowns, while when the market makes correction, usually to do quite well, decently well. So usually factors that I always like. Momentum, here, of course, you see a momentum that is the definition by MCI. We built our own momentum factor, and I show you in a moment very, very high level, of course. But that factors tend to be quite consistent in outperforming the market. So those two factors are the one to me that usually dominate. Value really tends to perform well when you have a market correction or when you have yields going up decently sharply. We are now in an environment where these events are of course more often, definitely, but being long value, meaning being short growth, and meaning being short the big tech names in the US is always a dangerous, very dangerous strategy. So you don't want to because you see the moves, the big moves, double-digit moves, sometimes 20% moves in the past years. So being wrong on that side is very problematic. So usually the active bets on those factors are more contained to manage the risk better. My quality is quite a stable overweight in portfolios. And momentum, as I said, it's also the case. You saw anyway that in the long run it proved to be an excess return generator. Maybe a bit more volatile, again, depending on the definition of your momentum factor, but it's quite an important an important element. Then what we added, and I'll show you later, is a factor on inflation, so characterized by period of high inflation versus low inflation. And that factor is also an interesting one. Show you the slide at the very end of this, because being able to be exposed to a factor that is driven by inflation is quite an interesting feature in this environment where inflation is going up and down with a larger magnitude than before.
Maybe, thank you. Maybe in the interest of time, rather than going through, your axioma and exactly what it is, what it does, which we probably don't have time, and maybe just highlighting 3 or 4 or 5 key slides with empirical application where your system can add value in the factor analysis. That would be more helpful. And then we'll leave 5 minutes to the end if you could comment and to the students what's happening in asset management in terms of careers, which kind of profiles you are looking for, which kind of universities and degrees and stuff like that. Yeah.
Definitely. Basically, axioma is the optimizer we use to build the portfolio based on a number of assumptions and limits that we can put together. I think we can go to the next slide. What I show you in this slide, even the next one, sorry. It was to try to make an optimization asking axioma to maximize exposure to a given factor. For example, here you see the factor I maximized was value, and basically you see the specific active risk is the idiosyncratic risk of a single names. Factor active risk is indeed the factor exposure. And you see that out of 49%, 34% is value. So it's nearly 70% of the factor exposure here is to value, as I asked the axioma to do. If we go to the next slide, here I tried to make more experiments, asking to have exposure to value, to growth, to profitability, to momentum, combining all together. What you can see is from the chart on the right, the table on the right, is the very different sector allocation resulting from a maximization of a given factor. So for value, I have a maximization of the exposure to financials, for example. On growth, okay, this could be a bit puzzle, but it was energy. So it depends also on the model in axioma. Profitability, in that moment, it was a discretionary. This is experiment done 1 year ago. Of course, these numbers can change in time. Momentum, probably not much of a stronger allocation, because it was quite a period where market conditions were changing. And the combination, in the end, you see it underweight industrials quite a bit, discretionary in overweight, services in overweight, etc. But you need to put really a number of other constraints in your portfolio, apart from, of course, the factor exposure. Anyway, we can go more interesting to this model that is basically the one we use for make stock selection in the MSCI World. What we did here was basically to combine the 4 factors, so value, momentum, growth, equality, detecting and testing different variables in order to see their ability to predict future excess returns. The variables we tested, so you see quality, return on assets, investment, etc. We combine these variables together with, let's say, some techniques that tend to allow us not to focus too much on the distribution, make assumption on the distribution, but rather to work on the empirical ones. and we combine these variables, penalizing more, let's say, the values that were quite negative and overweight to be the one that are quite positive. Is the next slide. So instead of having so variables with the same average may have a better or lower score depending on the fact that they excel or they are very negative on a given factor. Basically, starting on this, we have a weighting scheme which can be even very easily an equally weighted one. We get a classification for stocks, so a ranking of stocks based on the first quartile, second quartile, third quartile, and fourth quartile. What we do in the portfolio is to maximize exposure to the first quartile and minimize the exposure to the fourth quartile. We did this exercise the last 15 years. And you can see Q1 stocks tend to outperform the market in 2 cases out of 3, which is quite a big tilt compared to the 50% coin, let's say. And in particular, the outperformance of Q1 stocks versus Q4 stocks is very tilted on the right, meaning that they tend to outperform by quite a margin, while drawdown episodes are more rare. If we go back to the scheme we showed before, okay, here I reported the factors before for the US index. It's apparently on the US index. Now we are using this tool for a Wortman. You can see Q1 score of the stocks in the first quartile tend to have a much higher information ratio compared to the other. So you can see quality is still, as you can see, a very decent one. You see growth dominating the past 15 years, and indeed the growth information ratio in this period is very elevated. But the combination of the factors in the way we are constructing is much superior to a simple combination of the factors as built by MCI. So indeed, it's possible to work on the relationship of the variables, the economic theory, to select variables that are consistent with that, etc., to get better returns.
It's been a great journey. Maybe just a couple of minutes, say, not just in your teams, but throughout the firm, when you do a meeting, which kind of profiles they're looking for, which kind of skills they're looking for. Of course, the jobs are different, but just give an indication of what's going on at the moment within Generali Investment, who you're looking for, how you're looking for, and best way to prepare to look for a job.
No, definitely the quantitative skills are always something that is welcome, but more or better is the ability to investigate, let's say, in the topics. So it's quantitative word, so everything that is linked to that, which could be economic with a quantitative profile, or people maths, physics, etc., could be all very relevant profile. On the other hand, you have also the traditional analysis. So we have quite big teams, both in the economics and credit research. So analysis of balance sheets, etc., is a very important tool. And let's say outside front office, you have anyway a really big world that is made from sales and marketing to compliance. Compliance is quite an immense area that is a backbone of every structure nowadays. But of course, for a course in economics, I think it's one I mentioned before. So either you go for quant abilities, or you go for a strong balance sheet analysis, stuff like that. Or maybe not the best one entitled to say how we proceed with the recruiting, but anyway, the starting way and that everybody has to do is to insert the CVs on Generali website, trying to describe the best of himself, the areas of interest, etc. Because in the end, any recruitment process starts for the HR on that front. But there are also open days. Our HR anyway participates to events with universities, etc. So having the occasion to meet them in that cases could be basically also a good place. And anyway, you still have to provide your CVs. Let's say, I know it's difficult when you're young, but have a decent idea what you are interested to or what you like to investigate. I think it's important. On top of all I think curiosity is always the thing that provides you, let's say, a plus when you speak with the candidates. So when you are curious on something and you try to inform yourself beyond of what the university itself can provide. So having alternative sources of information, external press, foreign press, etc., always to better build your profile.
I think this is great. Last question, last chance to ask question. If not, either from the room or online. If not, we're just gonna thank our guest. Great, we thank you very much indeed.
Thank you, everybody. Thank you, Marcello, for inviting.
It's been really interesting to put things in perspective, and I think it's important also to get to know the DNA of each market. Like the question before, if you're buying the Italian market, also today's presentation gives you an idea a bit more what you're buying. Are you buying cyclical? Are you buying growth? Are you buying defensive? And so it's really a matrix of things we need to know to build, the most suitable portfolio asset allocation for the needs you have. Thank you very much, Generali Investments, and Luca Colussa. Great to have you again, and we'll be in touch again. Luca, thank you again. My regards to all your team and your colleagues, and thank you all online and here. Bye-bye.
Thank you, everybody.